Gold has been telling us that something is wrong in the economy and the global system for a long time, for a couple of years. Stocks and gold have been rallying together. And I think we're very close to the stock market starting a bigger pullback, potentially 10, 20% here. And we could see precious metal space rally up. I think the stock market is potentially putting in a top here, or only has a month or so left. I do think come January, I think things could get really ugly for equities. I do think it'll continue to be strong for precious metals for maybe a month or so.
And all of a sudden we're in a recession here in the United States. So we are teetering on a level of a retrace or a pullback that could be a lot bigger than expected. I personally think there's a little bit more downside to gold, and there's too many weak hands in the trade still. That not enough people have been flushed out. The markets just generally want to flush out the weak hands before it bottoms out for its next bull run. 5K next year to me is a no-brainer.
As gold hovers around $4,050 per ounce and silver near $50 amid recent pullbacks from October peaks above $4,354 respectively, precious metals remain strongly supported by unprecedented central bank demand. Record purchases exceeding 1,000 tons annually since 2022, led by emerging markets like Poland, China, and others, have doubled historical averages, driven by de-dollarization, geopolitical tensions, and safe haven flows. Even as some central banks begin accumulating silver for the first time in decades, analysts forecast sustained elevation into 2026, with targets up to $5,000 for gold. In a recent interview, technical analyst ChrisVermeulen, founder of thetechnicaltraders.com, delivers a contrarian, yet cautiously bullish outlook, warning that stocks are on the verge of a major top and potential 10 to 20% correction, reminiscent of 2007 to 2008, while money rotates into precious metals. Drawing parallels to pre-financial crisis charts, he sees gold targeting $5,100 and silver potentially spiking 60% toward $80 plus in a dramatic blow-off, fueled by equity outflows, though he stresses the need for a disciplined game plan, as parabolic rises in metals often end in sharp 30 to 60% retracements, and a strengthening dollar could eventually cap the rally. Let's watch clips from ChrisVermeulen's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
I mean, obviously, it's really hard to pick a top and figure out where that market is going to be, but when you look at it from a big picture standpoint, not much has changed in my kind of opinion of where we're at. I have a somewhat of a bearish looking outlook. The stock trends have been trading higher. We have been riding the market up, but overall the market isn't that strong. The Magnificent Seven have been doing a lot of the heavy lifting. The small caps and the micro cap space over the past couple of weeks have kind of broken down. They're showing signs that they're starting a downtrend. The S&P 500 and the NASDAQ look like they're starting a new downtrend this week. And it could be a fairly precipitous pullback. So that's the big thing right now. And, when we, step back and look at gold as well, gold has been telling us that something is wrong in the economy and the global system for a long time, for a couple of years. Stocks and gold have been rallying together. And I think we're very close to the stock market starting a bigger pullback, potentially 10, 20% here. And we could see precious metal space rally up, kind of like what we saw in 2007, 2008. I think gold and silver have got a very nice opportunity to the upside. The stock market is on the cusp of a real wake-up call for individuals. And the big question is when the market does roll over, do you have a game plan to not only profit or avoid the crash, but to profit from it as well in equities? Because I think it will be pretty dramatic once the music does come to an end at some point. We can look at the charts here. We can just look at the seasonality chart of the S&P 500. So I believe the S&P 500 may struggle here going into the end of the year. We're really on the cusp of starting a new downtrend. Now, seasonality wise, we generally see the market move higher into the end of the year. Now, it doesn't always work that way, but I think the stock market here is actually starting a downtrend, and seasonality I think is going to help hold the stock market up a little bit. I think equities are still going to fall. And I do think we're going to see money come out of equities, and I think we're going to see it go into gold. And we're kind of here in November, middle of November, which usually is kind of up and to the right for gold as well. And I think what we're going to see here is this a big rotation of money coming out of equities, moving into gold. And if we kind of look back and compare the 2007, which is the left side, the yellow line is the price of gold, which has been chopping around near the all-time highs in 2007. As the stock market started to sell off, Well, we're starting to see the same thing. We've got gold chopping around right now on the right-hand side. This is today, like where we are now, the weekly chart of the S&P 500. Gold is, or the equities are starting to struggle. And I believe we could see equities have a fairly decent pullback. And if we go back and look at 2007, you'll see the stock market ended up dropping about 20% and gold shot up about 30%. Silver shot up around 60%. Platinum, palladium also up about 60%. So there's some pretty good potential when money, if the stock market does start to sell off, Danny, we're going to see that, I think, that money flowing out of stocks, and money's always looking for return on investment. So it is going to go to whatever is working. And of course, I think we're in this sweet spot that gold, silver, and precious metals complex as a whole is going to really absorb and suck up all of that capital and send it higher. So we are very close. So you said runway. I think the stock market is potentially putting in a top here, or it only has a month or so left. I do think come January, I think things could get really ugly for equities. I do think it'll continue to be strong for precious metals for maybe a month or so, but there's not much runway. I feel like we're right on the cusp of the stock market making an all-time or a major market top before we start a recession or some bad news hits. And I think gold also has the same. It's a month or two away from topping, but stock market, not much upside. The precious metal space, I think, has quite a bit of upside. Like for gold, it'll bring us up to about $5,100 for gold. As silver, I'd have to look at it. Silver would be, it's roughly about a 60% move. So we could just quickly grab from where we are right here.
Mm-hmm.
So, I mean, we're talking way up, 80 and change here.
Right.
To the upside. So this is a pretty big move. I mean, I talked about $82 silver a couple of years ago, saying, if things were to blow off, that's kind of where it could go. And that's potentially showing where it could go if this similar type of situation unfolds. Now, you mentioned earlier, maybe there's a double top in metals here. We saw silver come up and get rejected a little bit. I think in the grand scheme of things, this is just a hiccup. And I think we're still going to see a very big push higher. I think this is a consolidation. I think we're going to see silver ramp itself higher. Same with gold going forward. But again, you have to have a game plan. If silver was to start to break down and break this low around, $45, you might not want to be holding it because it could unwind in a pretty big way. Silver has had a strong parabolic move to the upside, which you can really see when you drop down to the monthly chart, which you and I looked at last time we were talking. We can go way back even further. When things go straight up, they like to come straight back down. So that's what concerns me. But there's potential here, obviously, for silver to have a much bigger spike, because I do believe we're in the best scenario for precious metals to have a move than we've ever seen before. Now, every year the case for that gets stronger and stronger, but this time around it feels, central banks accumulating, and there's just a lot more, I think, power behind this potential move. So I think the precious metals space is going to be pretty exciting. It's just, you need to be ready, because when it does reverse, I think we could see a fairly strong pullback we could see 35% pullback in gold. We could see potentially a 50-60% pullback in silver when the markets do potentially run out of steam, when these little rocket ships going straight up eventually turn around and start coming back down. That's what silver does. Like if you go back, you look at these other parabolic moves, they fell, 88%, the one in 2012, depending where you want to go, 70%. So, I mean, silver is volatile. So we've seen the dollar fizzle down. It's carved out what looks to be a bottom. It's now, on the verge of actually having a really nice, real breakout here. It's got a series of bull flags. I think we could see this kind of ratchet its way up. And I could see the dollar index going back up to like 110, 116, 121, like huge moves that we haven't seen in a very, very long time. If that happens, that means probably the stock market and the economy is kind of falling apart. Eventually, once the dollar does start to rip higher, it's going to put pressure on commodities like gold and silver. They'll probably pull back with a strong dollar. So this is definitely a warning sign. I mean, this is, if we go back and compare 2000 and 2008, if we actually go and look at what happened, if I could find, what am I looking at for here? If we look at the dollar back in that time frame, you look in 2008, the green line, the dollar was out of favor. Everybody was thinking currencies were going to collapse. The dollar collapsed. If we look at the right-hand side of where we're at now, we look at the dollar is very similar in terms of, if I can get it to show here, the dollar's, it's gone all the way down to the right. It's under, everybody hates it. It's low in value. And eventually, if the dollar does start to scream higher, we're going to see stocks in gold fall. And if we go back here, if you look at the stock market in the background in 2007, it fell like 55%. Well, eventually the dollar put in the bottom and it rallied really dramatically. And the big rally in the dollar put some downward pressure on gold. And I feel like we're going to see something similar to that. I think the dollar could still struggle and bottom here for a while. I think gold could shoot higher, but eventually, I think you're right. I think the dollar is going to come to life here and put in a pretty big rally and catch a lot of people off guard. I don't know. So many people hate the dollar. It's like probably the most hated currency, I think. Everybody says it's going to crumble, but every time they think that, there's usually a sharp turning point in price, and it goes the opposite direction.
As gold trades around $4,060 to $4,070 per ounce after pulling back from October highs above $4,300, and silver hovers near $50 amid ongoing volatility, central banks remain the dominant force underpinning precious metals. Through the first 9 months of 2025, official sector purchases totaled over 850 tons, on pace for the fourth straight year above 1,000 tons, with Poland, Kazakhstan, Azerbaijan, and emerging buyers like Brazil accelerating acquisitions despite record prices. This de-dollarization-driven accumulation, combined with structural industrial deficits in silver and geopolitical safe haven flows, continues to provide a powerful floor even as short-term corrections flush out speculative positions. In a new interview, renowned market analyst GarethSoloway, chief market strategist at verifiedinvesting.com, warns that the S&P 500 has already formed a major top, with parallel channel analysis from the COVID lows signaling an imminent 10 to 20% correction, potentially escalating to 30 to 40% over years, as AI-driven concentration and excessive capex spending unravel, drawing eerie parallels between gold's current weekly pattern and the 1979 to 80 mania. He anticipates a final shakeout toward 3,600 to 3,700 to clear weak hands before an explosive move to 5,000 plus in 2026, viewing the least risky allocation in any drawdown as physical gold over stocks or even Bitcoin. Let's get back to the interview.
Again, when you have 75% of the S&P gains in the last 2 years, and we know how much the S&P is up in the last 2 years because of the AI stocks, if these stocks come in, they will take the whole market down as well. And then you also look at other factors, right? So 90% of GDP right now is being estimated to be just the capex spending from these big players. So now imagine that those big players just cut back on spending a little bit in the capex, and all of a sudden we're in a recession here in the United States. So we are teetering on a level of a retrace or a pullback that could be a lot bigger than expected. As a shorter term trader, because I'm looking for these pullbacks, I have to be more on the negative side in the near term. I certainly have more shorts out there. I've been attacking names like Nvidia on the short side and some of these other players as well. SanDisk has been a ridiculous mover recently. We've seen it just go parabolic. These are the types of things I live on in terms of their retraces. But let me show you this chart. This is the chart of the S&P, and I'm going to show you why we likely have reached a top in the S&P here. Now, again, we're talking about some of these Goldman Sachs players and other big players saying next 12 to 24 months. I think we've already topped, and I think it's going to happen a lot faster. What I'm going to do is I'm going to flip over to my weekly chart, and what we're going to do is we're going to go back to 2020. This is your COVID low right here. Now, take a parallel trend line, so we're going to use a trend line, and connect it through all of these lows. Now, what do we see? We see all of the lows, right? All of the lows essentially from the bear market low of 2022 through these subsequent lows. This was your Liberation Day sell-off low. They all line up in a perfect line, the beauty of charts. Now, drag a parallel line up to your bull market high in 2021, and what do we notice? Look at where we just tagged right up here. Now in 2021, we had a bear market drawdown. Notice how at the highs, we get pullbacks that are major, and at the lows, we get these big moves to the upside. And so as a technician, my thought process is very logical that if the last time we hit here, we got this big correction, and then from here we went up, and then we hit here and we went up again, what do we expect off of this? a bigger correction. And again, I think it's already started. I think the top is already in on the S&P, and the markets are now chopping because the buy the dippers are so willing. They've been conditioned. They've been brainwashed by big institutional money, by the government, by whoever, to think that the markets can never have more than a 2 to 3% drop. And they'll be very surprised at a 10 to 15% correction. But basically, you're starting to chop here, right? We have this drawdown. We had the drawdown here, may a move back up, drawdown. But look, lower high. And now the question is, will we come down and make a lower low on the S&P? But ultimately, again, the beginnings of tops are slower because you have people that have been conditioned to buy the dip, and then it'll speed up as we go lower. So I personally think there's a little bit more downside to gold. I'm still, listen, I have a huge amount of gold that I bought for a long-term portfolio that I'm going to hold, and I'm going to keep holding that regardless. But I'm also a swing trader, right? So I'm looking to see, okay, where could it pull back to? And one of the things we saw is we saw this top back in October, this first retrace, a big bounce, and it stalled out right in here, and now it's starting to come in. And I'm going to show you something here. This is a really, really cool chart on gold. This is the 1979 versus 2025 chart, and it's almost identical. So in 1979, we had this first bull move, and then we had this sideways consolidation. In 2025, we had this first bull move and sideways consolidation. We then in 1979, starting right here, 9 straight up candles in a row on the weekly, so 9 weeks up in a row before the big correction began. And we had this time in 2025, 9 straight up weeks as well, starting right here before we started this correction. Now, the reason why I think we still have to go a little bit lower on gold is that, number one, there's too many weak hands in the trade still. That not enough people have been flushed out. The markets just generally want to flush out the weak hands before it bottoms out for its next bull run. The other thing to go over is look at what happened in 79. Where did we pull back to before we started to get a big bounce? The former pivot of the consolidation. If we look at that right here, it's right in here in 1979. We pulled back there, and then we started to move up. Here we have it right in here. And that tells me that we could come back as low as 36 to 3,500 before the next bull move. Now, important here, and this is big because I'm sure you're going to get a lot of comments of people saying, oh, it's different than 1979. You're 100% right. It is different. The difference is in 79 and the 80s, Volcker was raising interest rates. Right now, Powell's cutting rates, right? In 1979, debt to GDP, 32%, 130% now. Now we have a government that just keeps spending money recklessly. Back then, they actually had, bipartisan agreements to make fiscally responsible things. And so the difference here is that in 79, we didn't see those all-time highs again for basically 20 to 30 years, right? In this period now, I think by next year, we're back at all-time highs. And so it is different. It's just the initial emotional reaction will be the same, but then gold should head back to new all-time highs. 5K next year to me is a no-brainer. But let's quickly flip over to Bitcoin. Let's bring that up and just take a look. So if Bitcoin goes down to my 75,000 target or 73,000 target, that would be a decline from current levels of about 23%. If gold breaks down to my 3,600 level or so, that's about a 12.5% drop. And then on the stock market, we've talked about that 10 to 15% drawdown. And again, that would bring us back. By the way, where am I getting 10 to 15%? It's our former pivot high right here. All right, so right around 6,100. This former high, as we broke down, once we break out, that becomes technical support. So Bitcoin has the most risk. The stock market to me is the most uncertain, where it could turn out that we're at a cycle high and we could see as much as 30-40% downside over the next few years, even though I do think that 10 to 15% gives us a bounce. Gold to me is the place where if I have to allocate money at any of these targets that we've talked about, I would probably do the most on gold because it's the least risky. And then probably secondarily Bitcoin at this point.
Both ChrisVermeulen and GarethSoloway agree that a major equity market top is forming, driven by overconcentrated AI gains and fragile breadth. With a 10 to 20% S&P 500 correction now underway that could deepen significantly, they see capital rotating into precious metals as the primary beneficiary in the near term. while Vermeulen expects a swift blow-off higher in gold toward $5,100 and silver to $80 plus. Before any serious reversal, Soloway anticipates one final shakeout in gold toward $3,600 to $3,700 to clear weak hands, mirroring 1979, before an equally explosive move past $5,000 in 2026. Despite differing timelines, both remain strongly bullish on physical gold as the safest destination amid impending stock market turmoil. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.